We are looking at an everything rally once again, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, markets shake off government gridlock as a wave of good news from AI and semiconductor companies pushes tech stocks to new highs.
Courting drug makers, the White House could ink more deals with pharmaceutical companies after Pfizer commits $70 billion to the U.S.
And Berkshire Hathaway scoops up Occidental's chemical unit for nearly $10 billion. It's Warren Buffett's biggest deal in 3 years.
Well, Matt, you pointed it out. It is the everything rally. And this morning, that everything rally, be it here in Asia, is being driven by semiconductors. So we're watching those semiconductor stocks this morning. Micron, Western Digital, all of them look like they're poised to start trading at all-time highs. Micron barely up, but Western Digital up more than 5% this morning, Matt.
Tesla is also going to announce its third quarterly deliveries in any moment. Third quarter deliveries, I should say. Analysts were expecting 439,000 in sales, and we know EV sales shot up as consumers raced out to get the last of the EV credits. You can see Tesla shares up 3.25% in the pre-market. Dani?
Yeah, and to be fair, we did already get some Rivian numbers coming through earlier this morning that weren't as good as expected. The Tesla numbers now just hitting the tape. Here to break it down with us is Bloomberg Tech co-host Ed Ludlow. Ed, what are you seeing?
Yeah, it's a massive beat, almost 500,000 vehicles in the quarter. Consensus was 440. This is an important moment in time because it's the bread and butter business. And remember, on November 6th, shareholders will vote on a compensation package that has a mandatory requirement for Elon Musk to deliver 20 million vehicles over a 10-year term. It is a massive beat. What I kept hearing from sources inside the company all quarter long was, hey, have you seen the advertising that we've been doing on YouTube, on Instagram? As you guys know, Elon Musk does not believe in traditional advertising. What I'm hearing happened was they experimented with paying for ads in the energy business, and they saw a direct uptick in sales. So they were like, let's do this with the vehicles as well. Also bear in mind that at the end of this quarter, at the end of September, the disappearance of the federal tax credit. And there was so much marketing material sent out by Tesla, like, remember, you have 1 week left, you have 1 day left before you lose that credit. So this is really big. And, you know, I do think that advertising piece has been a really important factor here. I know it has, based on the conversations I've been having. But remember, even in the most loyal Musk and fan base within the investor group, they have also been saying, come on, Elon, like, please do some advertising. So I find that extraordinary, and shares up 3% in pre.
It is. I mean, we saw Ford's EV sales rise 30% in the month, right? And Ford had done horribly badly with EV sales. They were like single digits. And so I think the end of the tax credits can't be put aside as a massive, massive driver for EV buyers in the quarter.
Although, Jim Farley's been speaking all week, hasn't he, in various places, saying that by the end of this year, you know, the share of vehicles in the market that are EVs could come down. They're, you know, below the 10% where they currently are. What's so interesting, Caroline participated in this conversation with Robin Denholm as well. We tried to get her to define political activity, and that seemed very clearly tied to Musk having a formal role in government. The reason I bring that up is that this data, again, in the third quarter, Tesla delivered 497,099 vehicles. Consensus was 440,000. Doesn't seem to be that Musk's ongoing activity on social media is impacting things here.
Yeah. And shares up 2% in the pre-market trade. Ed, thank you so much. Bloomberg Tech co-host Ed Ludlow, and it is a Bloomberg Tech takeover of Open Interest this morning because OpenAI has completed a deal to help employees sell shares in the company valued at $500 billion. That makes it the world's largest startup, and we have none other than Bloomberg Tech's other co-host, Caroline Hyde, joining us. Caroline, so this usurps the private valuation of Elon Musk's company, which I think was $350 billion. I mean, these are eye-watering numbers.
So it's once again pitting Sam Altman versus Elon Musk, who, of course, co-founded OpenAI together. And we know the fierce rivalry that certainly Elon Musk has with Sam Altman and the lawsuits that he flings his direction. So interestingly, the OpenAI leapfrogs SpaceX in terms of valuation. What's extraordinary, though, is that they raised just back in March funding from SoftBank. And now they've eclipsed that in the $500 billion valuation as well, adding more than $100 billion. This is a company that at the moment is having such an impact on the idea of generative AI, the way in which we use it. They're just throwing out more and more ways in which we can use it. Sora 2 came out this week, the way in which we can do image generation, and they have their own standalone app. They've been thinking about the way in which that we're going to be able to purchase, doing deals with Stripe so that we can do shopping specifically within ChatGPT. But the main thing is this is the scale of disruption this company brings. I would point out is now, if you look at it from a public company traded versus Netflix is bigger in terms of market cap than Netflix. But Netflix not only has a lot more revenue, some $45 billion worth, whereas we understand OpenAI is only going to have about $13 billion worth this year, it's also profitable. And OpenAI is not profitable because of the sheer scale of the AI infrastructure they have to bring to bear.
I mean, if they continue to execute on AI, look, I have two ChatGPT accounts, right?
Yeah.
I have the work account and the personal account, and I'm not an anomaly, at least here at Bloomberg. So,
but how much are you paying?
$20 for mine a month, and I don't know how much the company pays, but I imagine it's not cheap. I want to get, though, to the Microsoft story because we've been talking so much about about CoreWeave, with you and with Ed. We had the CEO on, Romain Bosic's show on The Close a couple of days ago, and now Microsoft is investing in a rival. Is that the case? In one of these neo-cloud businesses?
Well,
Nebius?
Well, this is Microsoft basically saying we should use more neo-clouds. Microsoft is in the business of building out AI data centers itself so it can offer Azure in the cloud to paying customers.
But they want more middlemen, right?
Yeah.
Who doesn't want to pay a markup?
Well, they've got to diversify, and they've got to be able to keep on scaling. This is a company that is an engineering force, a software force. Do they want to be ultimately a building force as well? They are having to use different and more creative ways of getting access to compute. You've seen that with OpenAI itself, trying to do deals with going with Oracle, with Microsoft, with NeoClouds as well. And we know that CoreWeave got a big deal with OpenAI. And then, of course, we've seen NeoClouds more broadly be serving the wider audience. I do think that you're going to see Nebius get money in from these various players. Look, Nscale just raised a pre-Series C days after having closed a Series B in the private market, so more than $1 billion. It was a record ever seen in Europe. Nscale is like the European version of a Nebius, of what's happening with CoreWeave. These companies are having to serve our extra need and desire for compute. Microsoft does want to diversify, so yeah, they're putting their money where their mouth is. Maybe they ink deals and they say, we're going to take your compute, but maybe they also say, we're going to take a bit of equity too.
Right, maybe it's also an admission that Azure just can't build enough of its own.
And the CapEx is unnerving for some investors,
yes,
right?
or both. All right, Caroline, we very much look forward to your show today. Caroline co-anchors Bloomberg Tech with Ed Ludlow. He's in New York this week. It's been a pleasure for us. Let's get, though, to the old economy. Berkshire Hathaway is ready to make its biggest acquisition in 3 years, the company reaching a deal to buy Occidental Petroleum's chemicals unit for about $9.7 billion in an all-cash deal. For more on this M&A, we're joined by Bloomberg Intelligence senior analyst Matthew Palazzola. And Matt, it's interesting because they already own a massive stake in the parent company, Oxy, I think like 27%, right?
Yeah, so they own about $11 billion worth of Oxy stock. I mean, I think it's a good deal, Matt, for both. The $9.7 billion price tag, that allows Occidental to deleverage a little bit, and they are highly levered compared to peers, which could help the equity. So while I think the business is a good business for Berkshire to get, it also helps Occidental in their goals, so it might help the stock as well.
Matt, it does seem like an era where heavy industry companies are looking at paying down debt, selling off parts of their business. Does it underlie maybe more stress or just a moment of transition for the wider industry?
Yeah, and Dani, I'm an insurance guy, so don't kill me in the comments about the chemicals industry. But I think what is happening specifically with this deal is Oxy was very highly levered. Part of that was acquisitions they made. So they were lacking a lot of financial flexibility. So they kind of needed to do something. Part of their lack of financial flexibility was the preferred stock that Berkshire owns in them. So they needed to do that. We're at like kind of trough cycle earnings for the chemical industry. So it was another kind of disadvantage for Oxy and advantage for Berkshire in this deal.
Hey, Matt, thank you so much for bringing this to us. That's Matt Palazzola of Bloomberg Intelligence. A quick check on your equity market. About 20 minutes away from the start of cash equity trading, we're up 0.3%. The Nasdaq outperforms, no doubt, thanks to Tesla. But here we are in the second day of Q4, starting the way we ended Q3 at all-time records, a 29th record high yesterday. Matt, if we do it again today, 30th record high for the S&P 500.
Yeah, so we continue to fire on all cylinders in terms of the, I guess it's a FOMO play maybe, or no one cares about anything anymore. It's interesting also, though, that you continue to see yields under pressure. We saw yesterday the U.S. 10-year yield come down, and right now it's bouncing back a little bit, looking at 4.11, so it had come down to around 4.10.
But it's remarkable, even very underloved parts of this market, like healthcare, are now participating in the rally. Obviously, something very specific there. But to your point, it's the everything rally, and Tesla adding to it this morning after those deliveries. Surprise to the upside, shares moving up by 3.2% this morning. And maybe the bar was low after some disappointing figures for Rivian, but is this just a sugar rush, to your point, Matt, after the coming end of tax credits?
It's also the everywhere rally, right? Because we see emerging markets powering higher. We see Europe powering higher, the continent, mind you, not London, obviously. The FTSE down a little bit. But coming up, President Trump is raising the stakes as the shutdown enters a second day with little sign of a breakthrough. In fact, it looks like things are getting worse. They're talking now about actually going through with the plans they had for mass firings, which seem like threats and a negotiating tool, but it was what they campaigned on. We'll talk about it in Washington next. This is Bloomberg Open Interest. Let's get now to high interest, a look at what's making headlines around the world. The EU plans on hiking tariffs on steel imports to 50% to align the bloc's rate with the U.S. Imports have been climbing as domestic output slips, and Brussels says it won't keep playing by rules that China ignores. The industry has been clamoring for tougher barriers. Now the Commission's draft plan sets quotas, adds review clauses, and gives itself sharper tools. If you can't beat them, join them. U.S. employers pulled back on hiring in September, announcing the fewest job additions for that month since 2011. Outplacement firm Challenger Gray and Christmas says companies plan to add just over 117,000 positions. That's down more than 70% from a year ago. The report points to a labor market that's losing momentum and hiring slowing, and layoffs, though not yet surging. With the government shutdown halting the official jobs report due tomorrow, the Challenger survey may be one of the few snapshots we get of the U.S. labor market. And the government shutdown is now in its second day. The Trump administration is raising the stakes in its showdown with Democrats, first by halting $18 billion in infrastructure funding for New York, and then by signaling a willingness to fire thousands of federal workers. Vice President J.D. Vance, though, denies the moves are politically motivated.
We're not targeting federal agencies based on politics. We're targeting the people's government so that as much as possible of the essential services can continue to function. That is the question the president has asked the entire government.
President Trump, meanwhile, makes no bones about how he viewed the stalemate earlier in the week.
We're doing well as a country, so the last thing we want to do is shut it down. But a lot of good can come down from shutdowns. We can get rid of a lot of things that we didn't want, and they'd be Democrat things.
No politics or Democrat things. Let's get the latest update on the government shutdown with Bloomberg Washington correspondent Tyler Kendall. Tyler, where does the stalemate stand? Does it look like either side might budge and we finally end the shutdown?
Well, Dani, at this point, we really are at an impasse, though I can say that the lawmakers that Joe Matthew and I spoke to on Balance of Power last night did express cautious optimism. All of them confirmed that there are talks happening behind the scenes when it comes to Democrats' chief ask, which is negotiating those expiring ACA premium subsidies. Now, our analysts at Bloomberg Economics say that extending these expiring tax credits would cost $350 billion over 10 years. So there's a lot of issues that need to really be hammered out with this, including how long they would be extended and whether or not there's going to be a forcing mechanism to have lawmakers talk about this after the government reopens, or if pen has to meet paper before they can actually reopen the government and get Democrats fully on board. Because at this point, as I said, they're just talks. Our indication is leadership is not involved here, and we haven't seen emerge what's known as a Senate gang, essentially a group of senators that would serve as those bipartisan brokers. Now, A few different senators, Matt and Dani, did tell us that today the Senate is, of course, out in observance of the Yom Kippur holiday, but they expressed optimism that this could allow lawmakers to perhaps take a step back and continue these negotiations without the threat of a vote hanging over them. They are expected to reconvene tomorrow and vote again on the Republican version of a stopgap measure that would cleanly fund the government as it's known until mid-November.
I wonder, Tyler, how this administration will do in further reducing the federal workforce. That was something they campaigned on. It's something they pushed for at the beginning of the year. And this seems like their chance. Beyond negotiating with Democrats, beyond the politics of it, they could use this opportunity to really lessen the federal workforce. Are they going to actually do it?
Well, that's the big question that we're waiting an answer for, but perhaps we'll get a little bit more clarity later today, as President Trump did confirm in a post on Truth Social. He has plans to meet with the OMB director, Russ Vought. But I can also say that Republicans that we're talking to are urging caution when it comes to this issue. Take Senator Dan Sullivan, a Republican from Alaska, sat down with Joe Matthew on Capitol Hill yesterday, and he pointed to the federal workers in his state. A little less than 5% of Alaska's total workforce are federal workers, which reminds us that only about 20% of the total federal workforce is concentrated here in the Washington, D.C. metro area, which means that this really is going to be something that these lawmakers are going to hear from constituents nationwide. Now, it is worth pointing out that an analysis by Bloomberg of government agencies' contingency plans that they have to submit to the OMB in light of a shutdown did not outline permanent layoffs. So we don't have a lot of visibility into exactly who would be at risk unless we're going off of the OMB memo that we saw released and obtained last week, which did outline some of the different priorities that could be kept safe if they're in line with President Trump's agenda, while Russ Vought appeared to direct agencies to look into those areas that haven't gotten new funding from the One Big Beautiful Bill or aren't funded by mandatory funding. So those are sort of the areas that we're going to start to dig into to see whether or not this actually comes to light.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from Washington. I will say that if you don't have access to non-farm payrolls data, and if you, well, we're not going to get that tomorrow, right? Yeah. We're not going to get the CPI. We're not going to get all of these government-issued data points. Bloomberg on the terminal has a list of alternative sources you can look to for guidance. WSL space ALTE go is the best way to pull up that list.
And you know who's going to be needing that guidance and probably that function is the Fed. Austin Goolsbee yesterday saying the Fed is going to a period where we're trying to figure out, is this a transition? And then you're not going to get the data. It is just that much harder.
He said the non-farm payrolls number is literally the best piece of labor data in the world, which... I mean, in the whole world?
What's better, ADP? ADP has been a bad indicator for where this labor market is
going.
True,
but there are other countries. I imagine a command economy has access to nearly perfect data.
Okay, that is a fair point. I take your point when you say the world.
Coming up in the next hour, we're going to discuss the shutdown, deal-making, and more with Guggenheim co-chairman Jim Millstein. This is Bloomberg Open Interest.
Let's look at some of the stocks moving ahead of the opening bell in about 7 minutes' time. Pharma companies are apparently fielding calls from the White House to ink deals like Pfizer's, which gave it a 3-year tariff reprieve. We're going to get more on this with our markets correspondent, Nora Melinda, in a little bit, Matt. But worth pointing out, healthcare was the only down sector before this most recent rally year to date.
Yeah, and it has really powered higher over the last 3 sessions. It's already Thursday.
Yep.
Congratulations. Monday, Tuesday, and Wednesday were awesome. Is this a pre-market board, Will? This is a pre-market board, right? So they're not doing well today, but no. They're just giving back some of the massive gains they've made. You saw FICO there. The other credit reporting companies are slumping after FICO, that's Fair Isaac at the bottom, offered mortgage lenders the option to calculate and distribute FICO scores directly to customers. As a result, everybody else is down, and Fair Isaac is up 16%.
Well, the other thing lifting up markets that has been doing all of the legwork as of late is semiconductor stocks. Micron, Western Digital, they're all trading at all-time highs. And the sector is leading this everything rally we've been talking about this morning, Matt.
Yeah, absolutely. Crushing it. Let's dig into the rally with Bloomberg's markets correspondent, Nora Melinda. She joins us here on set. And Nora, it has been really the pharma stocks ever since Pfizer's meeting with President Trump, just powering this market higher. And obviously, the AI play, the tech trade also is helping to move things along nicely.
A lot going on right now, as we were talking about a bit earlier. I mean, a lot of these pharmaceutical companies, the executives there are fielding calls from the White House staff almost daily. And they're trying to strike a lot of deals. I mean, the White House has really talked about the fact that they want to invest in a lot of these companies here, especially the ones that are U.S. based here. They're really pushing a lot of these pharmaceutical companies to sort of develop a relationship with the White House. I mean, of course, if you think back to the conversations that we've been having earlier this week, just chatting about Pfizer and the deal that they struck with the White House to get a 3-year tariff reprieve there. You've also got Eli Lilly. They're really pushing that company to talk about different ways that they can finagle things to make it a bit more positive here for the government and the relationship that we have there. I mean, they're really just looking for industries across almost 30, especially as they're thinking about those are critical to national or economic security here.
Nora, only a minute, but it's not just pharma. It's also chip makers, adding so much weight to this rally.
Added $200 billion if you look across the globe here when we're looking at chip makers, especially as we think about the AI exuberance that's really being demonstrated if you look at the gains that we saw at the end of this past quarter. And of course, as you're continuing to see the rally into today, Mag 7 stocks, all of them up across the board.
I will say, a couple of days ago, I gave out my email here on live TV. It's never recommended.
But you did. But any terminal user can find you anyway.
Mine is mtmiller@bloomberg.net. And I got an email from a guy, I'll call him Chuck. He said, there's a real shortage of gas turbines. And we have an amazing story today about Siemens selling a ton of them. And Caterpillar has had a huge rally because they apparently make them as well. So gas turbines, also a story in the AI supply chain. Nora, thanks for joining us. Nora Melinda there covers stocks for us. Less than 4 minutes to the opening bell. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Dani Berger is back. We're rallying. Everything is right with the world. S&P futures up more than 0.25%. NASDAQ futures with tech stocks leading the way up 0.6%. Even the small caps are along for the ride. You hear the opening bell down at the New York Stock Exchange. Crispy. Kirice, I don't know what it's called, but KRSP is the ticker. By the way, yesterday, the guys who rang the bell here, Neptune, ticker NP, they were doing an IPO, up 24%. One of the founders is $1.2 billion richer today. They crushed it yesterday. You have Kanda IM Venture ring the opening bell down at the NASDAQ. They seem very excited. It's an historic event. Why not? Celebrate with your closest friends. Dani, we're seeing everything up today. Tesla doing well. Sales are higher.
Yeah.
It's a tech stock. It's a car maker. What can you tell us?
Yeah, I mean, it's a bad day to be a bear on this overall market or a Tesla bear. They posted a surprise gain, Matt, in quarterly vehicle sales. So shares up just under 2%. 497,000 cars is what they had in the third quarter. The expectation was for 439,000. But there is this question. Is this just a temporary sugar high? Because EV tax credits are expiring, Tesla, we're talking to Ed Ludlow about this big marketing push saying go and buy your Tesla before it expires. So how long lasting can this really be?
Yeah, that's a good question. We'll be watching to see. I will say other car makers doing well today. Stellantis was up like 6.5%.
Not Rivian, though.
Pre-market. Rivian, still sticking with that 400-volt architecture, which in my opinion, I'll editorialize a little bit here. Not the best choice. Semiconductor stocks are driving the global market rally with Micron and Western Digital hitting all-time highs. You can see it always helps when NVIDIA rises as well, 1 2/3%. When a $4 trillion company gains, you typically see all the boats rise. Let's bring in Wells Fargo Investment Institute Global Investment Strategist Veronica Willis. And Veronica, you're overweight these large mega cap tech companies still. Have you not been tempted to take profits and rotate out?
Yeah, I think it's tempting to really take those profits, but at the end of the day, we are still expecting these big companies in these sectors to still do well. We like financials and we like tech, and we think that this environment with the Fed cutting rates. We're expecting 2 more cuts this year, that financials are going to do really well. And we think with that longer term AI theme, that tech is still going to do really well.
It's kind of incredible because so much in this market has been rallying. A lot of it has been what gets the residuals from tech, what's more productive. Pharma was one industry that was left for dead this year. Before this week, Matt and I were talking about it. It was the only sector that was down. Now it's full on participating in the rally because maybe striking some deals with the Trump administration. How do you think about pharma and generally when a rally is built off of policy coming out of the White House?
I think it's risky to think about the sustainability of a rally when it comes from policy because there's ultimately going to be a lot of uncertainty around policy. And so I'd just be a little bit cautious there, focus a little bit more on fundamentals and focus a little bit more on what we're expecting from the economy and how that's going to impact markets.
It's strange if I look at the, on the Bloomberg, you have to type SPX L1 index GRR to see a breakdown of just 11 industry groups. I look year to date and you see the defensive sectors all at the bottom. They're all gaining, mind you, but consumer staples, real estate, healthcare, energy, all the least best performers. Why do you think bullishness, optimism is so strong here? I mean, your target is for this year is 6,700, and we're above that now.
Yeah, I think that the market has done really well once we got through the worst of those kind of tariff uncertainties earlier this year. But we think that there are a lot of catalysts for some market volatility, and so we could see some pullback later this year. Even thinking through 2026, we are expecting the market to move higher, but I don't think it's going to be a linear move up. There's going to be some volatility along the way, and having a little bit of exposure to some defensives could help protect for that volatility. So we do like utilities right now for that reason.
Well, to be fair, some of the stocks facing mass consumers have been doing really bad. Bespoke put together an index. It has Walmart, Target, Costco, BJ's, some of the discount dollar stores. It's down 11.5% since the end of Q2 in pretty much a straight line downwards. Would you be avoiding, even though the American economy looks good, but any stocks that are facing mass consumers right now because of the whole K-shaped thing?
Yeah, I think it's really tricky thinking about the consumer. Consumer confidence has been weakening, but consumers have still been spending. But then you really have to look into what are they spending on. And so there's going to be this shift to spending on those necessities more than spending on the things that are a little bit more discretionary. And so that's part of the reason why we're a little bit cautious on the consumer discretionary area, because we do think with an economic slowdown, there's going to be a little bit of shift there in the consumer.
I will say, Dani, ever since Jonathan Levin wrote that piece on Costco's estimated PE, they're trading at 45 times next year's earnings, right? Walmart is trading at 38 times next year's earnings. Target, 11.
Wow. So Target is the underloved one. To be fair, that they've had to think of a whole strategy rethink Target has. So some troubles there, but the stocks haven't been doing as well.
No. I want to ask finally about small caps, Veronica, because some people have taken a punt, and said, like, it's got to work this time, right? You don't favor small caps, but if the Fed starts to cut more aggressively, if we got, say, a 50 basis point cut, would you leg into them?
I think it could be a nice little bounce for small caps, but I don't buy that it's going to be something sustainable, especially with where we are with the economy. It's just not an environment for small caps to do well. It's more of an environment for those large and mid-cap companies to outperform, just because they're going to be able to be a little bit more nimble to navigate all of these uncertainties. They've got more cash on the balance sheet, and they're going to be able to do the shifts necessary to be a little bit more resilient.
Thank you so much for joining this morning. It's great to have you on a day where everything is going up. Veronica Willis of Wells Fargo Investment Institute, global investment strategist. Let's get a check on the stock market right now, about 6 minutes into your trading day. And again, here we are headed for, what is this, the 30th all-time record if we hit another record high today? We did yesterday, so by any stretch of the imagination, we will today. Matt, you pointed this out. It's the chip makers, thank you chip makers, that keep adding to this rally, $200 billion. It is NVIDIA leading the charge. A close second behind is Broadcom, who Nancy Tangler loves to call the poor man's NVIDIA. I don't know if you can call it that anymore, given the rally. To the downside, it's also tech. Netflix down 2%. There's been kind of this like Elon Musk-driven call to boycott Netflix. Not totally sure what's going on there, but seems another day of declines for them. Visa, Apple, JP Morgan also down this morning. Let's look at some of the individual sectors and how those are shaping up. You can see it's a really top-heavy day. Yes, we are gaining, but it's thanks to tech. It's thanks to NVIDIA, because you have real estate, consumer staples, utilities, communications, healthcare, financials, consumer discretionary. All those are doing worse. So, Matt, it is another day where breath is not looking great, but thank you, tech, for saving the day and getting us to another all-time high.
Yeah, the big heavy hitters pushing us higher. Also, shout out, you saw Caterpillar there among the winners.
Yeah.
I love that turbine story Bloomberg News wrote today. And then FICO offering mortgage lenders an option to give credit scores directly to consumers. That lets them bypass the Experians and Equifaxes of the world. Let's get a conversation going about this with Bloomberg Intelligence senior policy analyst Nathan Dean. Nathan, I will say, these credit score bureaus are the bane of many Americans' existence. So a lot of people celebrating the downfall of those companies. Are they going to go away?
No, I don't think they're going to go away. And one of those individuals that most likely will be celebrating is going to be FHFA Director William Pulte. He said on X that he's going to have a statement, and he's been pressuring Fair Isaac in particular to lower the cost for mortgages. Now, what Fair Isaac did here is they essentially cut out the credit bureaus. The credit bureaus, when they use a FICO score, when you go forth with a mortgage, they charge about $10 per score. What FICO is doing is now saying, look, we're going to cut you out, and we're going to charge $4.95. So how does the credit bureaus respond? Well, we're talking about a significant portion of their revenue, but it's not everything. So they could potentially bundle this, whether it's services. Employment verification has become a new winner for the credit bureaus over the last couple of years. But they also have a rival score called the Vantage score, which they could be pushing further. But ultimately, for these credit bureaus, it's going to increase competition, really hit their margins on the mortgage space, and really pressure revenues.
And you can see just with the FICO move, Nathan, the stock just halted trading because of volatility to the upside, up 22%. I think a lot of people would look at this news and say, how does it help me? As Matt pointed out, people hate these credit rating agency bureaus because of the issues of transparency and understanding exactly what goes into it. Does it change anything for day-to-day people who look at their credit score and hope to improve it and hope to even understand it?
Not right now, but I will just say is we are awaiting this statement from FHF Director Bill Pulte, because I don't think this is the last of what we're going to see going on with credit reporting agencies in particular. He's had several discussions with FICO. He's also had several discussions with the agencies themselves in terms of trying to lower the cost from mortgages. But why stop at mortgages? There's going to be other things out there that, you're going to see policymakers be focused on to try and lower these scores, or not lower the scores, but lower the price of these scores in the impact that they have on everyday Americans. But that's why I think the credit bureaus have also been shifting their focus over the last couple of years. Like I just mentioned, employment verification, and also just into different types of information of when you need to verify who you are and verify, your source of income and so forth like that. So, I think the credit bureaus are going to be able to respond here in a way where I don't think they're going to be able to ultimately be able to claw back some of the lost revenue that's going to come with this move. But there's a real strategic reckoning coming for this industry because, the pressure is going to continue. It's not going to go away.
Yeah, and again, just absolutely giant moves in stocks reacting to this TransUnion you see there, down 13.8%. FICO up 22% before a trading halt. Nathan, thank you so much for that. Bloomberg Intelligence senior policy analyst Nathan Dean. Coming up on the show, Tesla and Stellantis deliveries are driving those stock moves today. Stellantis up 8.5%. Tesla, some of the gains starting to lessen this morning. We're going to have details with our head of global auto coverage. That's coming up next on Bloomberg Open Interest. Let's get you some top calls, some of the analyst ratings that we're looking at this morning. First up, Nike, that gets upgraded to a buy at KeyBank after its earnings that showed signs of recovery. The analyst over at KeyBank said that there's enough visibility to feel comfortable in the broader turnaround story. Those shares up 3.25%. Next up, chocolate maker Mondelez, that gets a downgrade at Berenberg. Berenberg warns of near-term industry weakness thanks to warm weather and price sensitivity weighing on European demand. So those shares down about 1%. Why don't people want chocolates? That's sad. Finally, JP Morgan is raising its price target on Alibaba, another one, to a street high of $245. That implies a 36% gain from its close yesterday. They see significant room for upside thanks to the company's strengthening cloud outlook and growing synergies between AI and its e-commerce operations. Those shares up 4.5%, just thereabouts. Matt, there's so much bullishness on the stock. and it's already doubled this year.
All right, is it Golden Week or what is it? It's a whole week-long holiday.
Yeah.
In China, I think we're getting into it.
I think that's right.
Everybody just shops the whole time.
My kind of holiday.
That is not bad for Alibaba. All right, Tesla posting a surprise gain in quarterly vehicle sales. Shares are just turning negative. At one point, we did hit a new record high in Tesla shares. They jumped up to over $1.5 billion, still trading at more than $1.5 trillion in market cap. The EV maker delivered more than 497,000 cars in the third quarter. Analysts were only looking for 439,000. Bloomberg's Craig Trudell leads our global autos coverage. And Craig, you know, we were debating earlier with Ed Ludlow from Bloomberg Tech about whether this is because, you know, the tax credit expired in the last quarter, at the very end of the last quarter, or if it's because Elon Musk is finally listening to some of his underlings and doing some actual advertising.
Yeah, I suppose the advertising could help a little bit on the margins. I do think the struggle that this company is going to have to sort of replicate this kind of success without the $7,500 tax credit cannot be understated. You have to give them credit for posting this number, of course. But I think, you know, it was clear that throughout the quarter here in Europe, the sales were extremely weak. I think even in China as well, you saw a sustained, you know, not so much of a drop as we've seen in Europe, but a real struggle to sort of keep up with the growth that you're seeing out of, you know, say Xiaomi, or keep up with, you know, the numbers that BYD does in China. So, you know, you kind of, by process of elimination, have to sort of conclude that the U.S. is what really sort of carried things this past quarter. And it's no surprise in that, you know, we saw just yesterday across the industry, every manufacturer that's selling EVs sold a heck of a lot more of them before these tax credits go away, because this is a substantial perk for buyers. You know, consumers wanted to lock that $7,500 in before it went away.
I was going to say GM, Ford, Hyundai, all of them posting really strong numbers, to your point, Craig. So it's not just Tesla, but how exposed are some of these other car makers to the EV tax credits starting to go away? What sort of ramifications does it have for the industry as a whole if we're just now getting this temporary sugar rush that might fade out?
Yeah, I mean, Rivian's a good example of a, you know, similar trend where we saw a better than expected third quarter, and yet they offered an update on their guidance for the full year and narrowed the forecast range. The midpoint of that range is lower than what it was previously. The company already was calling for a decline and you know, sort of, I guess, kind of calling for the fourth quarter being, you know, a substantial, you know, drop from what we saw in the last few months. And I think even, you know, sort of going into 2026, it's not just that that EV tax credits are going away. It's also that, you know, sort of less appreciated changes in policy, you know, limiting fuel, limiting tailpipe emissions, and also setting standards for fuel economy. Those are all going by the wayside as well. So, you know, the likes of Tesla, Rivian, and Lucid, they can't count on being able to sell regulatory credits to other manufacturers that need help complying with those tougher standards. And that's another headwind that these companies are going to have to contend with.
It's a great point. I can't remember if it was David Welch or Keith Naughton or Gabby Coppola. We have an outstanding autos team who wrote the story that, you know, GM and Ford and Stellantis, I guess, they're no longer going to pay like $1 billion, $2 billion, $3 billion a year for these credits. So that has to be a huge, like, multi-billion-dollar loss for Tesla.
Yeah, and this is, of course, the case that their regulatory credit revenue is not just limited to the U.S., but that is where they do, you know, the substantial portion of their business. And it's also the case that here in Europe, we've seen the EU sort of blink when manufacturers were making a lot of noise earlier this year about, you know, the next sort of leg up in fuel economy standards or emission standards for the EU. There was a willingness to kind of average out over a few years instead of making 2025 a next sort of step change in those standards. And so you'll also see some slack in terms of regulatory credit revenue for EV makers here in Europe. So this is a you know, pretty global story for Tesla, and something that we're going to find find out more about when they report quarterly earnings in a few weeks.
Yeah, in the meantime, a volatile day for Tesla. It's up, it's down. It was up moments ago, now down about 0.5%. Craig, thank you so much. Bloomberg's Craig Chudell. Coming up, pharmaceutical companies are exploring deals with the White House to avoid tariffs and political scrutiny. That's according to a recent Reuters report. We're going to have that for you next. You're watching Bloomberg Open Interest. Reuters reporting that pharma executives are getting near daily calls from staff at the White House to ink deals. It also follows Pfizer's $70 billion investment in the U.S. in exchange for a 3-year tariff reprieve. Let's bring in Bloomberg Intelligence senior pharma analyst Sam Fazeli. And Sam, if you look at the Reuters report and some of the things that allegedly is happening, talking about more deals with Eli Lilly, providing more medication, having AstraZeneca build in the U.S., there's some really big, bold calls here. We know Pfizer is moving forward with a deal. How likely is it that the rest of the pharma industry also inks deals?
I would say it's very likely. I'm expecting news next week. I think the president suggested Eli Lilly could be the one that's next. I think it's more likely that the US pharma companies are going to be closer than some of the Europeans, not necessarily for any reason other than they're based in the US. So, but I wouldn't be surprised to see AstraZeneca very soon there already. I think Pfizer set a very nice blueprint for how this can go forward, and investors have been happy. The companies, I think, are fine, and also the White House and the president is getting what he'd been hoping to get and looking for.
So at the end of the day, Sam, I think it matters to the White House, to the Republican Party, especially as we get closer to midterms, that drug prices do not go up, and would be beneficial to them, actually, if drug prices really, truly come down. I'm sure we're not going to see European-level prices, even if we get supposedly most favored nation status. But will we see that? Will we see a reduction in the amount that American consumers or their insurance companies pay at the drugstore?
Yeah, I think what we need to focus on there, Matt, is the net price that we've been going on about forever, not the list price, because the list price goes up with inflation, maybe slightly above inflation. What is focal point here is the net price, which is what's going to be hitting these direct-to-consumer platforms, such as Trump RX or whichever, whatever name it's going to have in the end. I think it has a different name. And Lilly has got its own platform. AstraZeneca's got a platform for one of their drugs. So I think you will see it there. And I'm pretty sure the White House will make a point of highlighting which of these drugs have actually had a reduced price, or at least access directly to patients at a lower price than they would be getting through the standard system. And the companies announce it. I think it's their incentive to do it. So I'm expecting to hear more and more. AstraZeneca's announced one recently. So we will see this, I think.
All right, Sam, great to get your take. Sam covers the pharmaceuticals for us, runs the coverage globally for Bloomberg Intelligence. Sam Fazeli there out of London. Coming up in the next hour, Cameron Dawson joins us of NewEdge Wealth. We've got Guggenheim's Jim Millstein on the shutdown as well as deal activity. And we've got David Neeleman joining us. He, of course, the founder of JetBlue, now runs Breeze Airways. We'll talk about consumer demand for travel, all of that and more coming up on this day. Another record high day for the S&P.
On our way to a 30th.
Number 30. Could be. I mean, look, the gains are diminishing. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, with stocks trying to hold on to gains on track for a 30th record high.
Yeah, coming up, markets shake off a government gridlock, or it looks like we are now. Maybe we won't all day. We have a press conference from House Speaker Mike Johnson to determine how things go forward for now.
And what does that mean about the data we're going to get? So far, the latest Challengers report showing employers dialing back hiring plans. It offers a glimpse of the labor market as that government shutdown has been delaying official data.
And years after years of getting shunned by major banks, debanked, as his family says, President Trump's money has found a new home. And it's at Citi. Details on that scoop later on this hour.
Well, we begin, Matt, with, as we've been discussing, stocks attempting to post a fifth straight day of gains, a fifth straight day of record highs. We caught up with Veronica Willis of Wells Fargo earlier on her outlook for equities.
The market has done really well once we got through the worst of those kind of tariff uncertainties earlier this year. But we think that there are a lot of catalysts for some market volatility, and so we could see some pullback later this year. Even thinking through 2026, we are expecting the market to move higher, but I don't think it's going to be a linear move up. There's going to be some volatility along the way.
Let's continue this conversation with Cameron Dawson of NewEdge. Well, she is the chief investment officer there. Cameron, what do you do in this situation if you have, a FOMO-driven rally or a market melt-up that's not really underpinned by fundamentals, or at least doesn't keep valuations in mind?
Well, I think that there has been some fundamental underpinning for this rally. The fact that you're still making 12-month forward earnings estimates make new highs. That means that as you see earnings estimates get revised higher, that is a very good environment for risk taking, which is one of the reasons why we think we continue to see multiple expansion, even though multiples are already extraordinarily high. So we think that this market really hinges on that 12-month forward earnings number continuing to move higher. If it levels off, or heaven forbid moves lower, that's when we think that you would usher in more market volatility. But until then, you still get this kind of melt-up dynamic.
If you were to be nervous, what would you even recommend doing? It's not a market where you can short anything because literally everything is rallying. You have a bond market that's been volatile, that recently has been rallying on the front end. What do you turn to if you do feel a little bit of those jitters right now?
It's certainly something that we've seen a lot more questions from clients about hedging, and there's certain hedging techniques that you can do that aren't too expensive, that you can add some buffers into portfolios. But we think one of the best ways to navigate environments is to really focus and stay disciplined on quality. Quality has the aspects of being able to participate in upside markets, maybe a little bit less because we've seen a lot of junk rallies since the April low, but it has really good downside capture, which just means that it tends to do well in more volatile periods. So staying disciplined, not necessarily chasing some of those low quality, junky hot dots, is exactly how we have been positioned through all of this.
So how do you define quality? I mean, when you screen for stocks that are quality, what are you screening for?
So there's a whole host of metrics. It really starts with things like free cash flow generation through cycles. We care about cash, not just necessarily adjusted earnings. We're looking at balance sheets. We're looking on return on invested capital. This is an important one because as we think about ROIC, it's how much money you're putting into the business to generate profits. And one of the things we're watching really closely is a lot of the Mag 7, very high quality names of the past are starting to invest a lot in CapEx, and not starting to, have been doing so the past couple of years.
No longer asset light.
They're not asset light. And so they're going and being asset heavy businesses in areas that are far more competitive. So we think that over time, this is something that could degrade return on invested capital in these areas, but the market doesn't seem to care about that for now. Eventually it will, but it could take a few years.
By the way, maybe this is why we see Microsoft using these neo-cloud businesses. Instead of building up completely its own infrastructure, right? They go to CoreWeave or they go to Nebius instead.
Right, form a partnership, but it doesn't even matter, I guess, because it is a market, to your point, Cameron, that will reward you for now if you spend more.
Well, exactly. And I think it's important to remember that we are clearly in the CapEx phase of this technology cycle. And we learned that back in the internet cycle, which is that you had a massive CapEx build out, and the names that benefited from that were very distinctly different than the names that benefited from the ultimate application of the technology. So one of the things we're watching is how will that shift as we move into the later innings of this CapEx cycle.
Hang on a second, Cameron. The Speaker of the House, Mike Johnson, is holding a news conference. We want to listen in.
Well, welcome everybody to day 2 of the Democrats' shutdown. Let's make absolutely clear what's happening here. Real pain is being inflicted upon the American people because 44 Democrats in the Senate have voted for the 3rd time to reject the completely nonpartisan, completely clean, very simple 24-page continuing resolution that we passed in the House here 2 weeks ago. Now, why did we do that? For a refresher for everyone, we have been working very hard, this leadership team, to get Congress working again. Congress has not done the appropriations process appropriately for many years now. And so we have forced the muscle memory back. Our appropriators have done a great job in bipartisan fashion, by the way. And they've worked very hard and passed 12 separate appropriations bills through the committee, as is supposed to be done. We passed 3 of those off the House floor. The Senate did its work. For the first time in years, the Senate passed 3 appropriations bills off the floor. Those bills don't match up exactly. So the way the system works, everybody remembers from civics, is that when the 2 chambers have bills that don't align perfectly, you put together a conference committee. That's been done. All of that work's been done very deliberately, very carefully, and as good stewards of taxpayer resources. The problem is we ran out of time because the end of the fiscal year is September 30th. So we did the logical, simple, good faith thing. Instead of loading up a continuing resolution to keep the lights on, to keep the government open so this process can continue, instead of loading it up with poison pills or gimmicks or tricks, we sent over a very simple continuing resolution that every single Democrat in the Senate has voted for in the past, just to keep the government open for the people, so that we could get to November 21st, 7 weeks, to allow more time for this process to play out. That is what happened. Now, the Democrats did something they've never done before. Chuck Schumer has led them all to vote against it. Everybody's been discussing this for the last few days. Why in the world would Chuck Schumer do a 180-degree turn? Because he said passionately, as recently as March of this year, on the same instrument, the same CR, that it would be reckless and irresponsible and dangerous to close down the federal government. Why did Chuck Schumer change his tune? Everybody knows that now. He's trying to avoid a challenge from his left flank in his next Senate re-election campaign. And he wants to avoid the scrutiny that he received for doing the right thing back in March, because the far left and the base really went crazy on poor Chuck Schumer. And so he changed his tune. And now they're trying to pretend it's about something completely different. They have made a decision that they would rather give taxpayer-funded benefits to illegal aliens than to keep the doors open for the American people, to keep vital services, veteran services, health care and nutrition for women, infants, and children. They would rather not pay the troops and TSA agents and Border Patrol agents. They would rather stop services of FEMA in the middle of a hurricane season than to do the right thing for partisan political purposes. It is selfish, it is reprehensible, and it is exactly the opposite of what they have all said themselves in their own words very passionately every day until now. We've been playing the greatest hits loop here on a video right outside the Speaker's office for days. You've all seen it. Make them answer for that. Don't ask the Republicans what we should be doing or what we should be negotiating. I don't have anything to negotiate. I sent them in good faith exactly what they had voted for before. We did not put any Republican provisions in that. And we tried to make this very simple, in good faith, so the appropriations process of the people can continue. Now, there's been a lot of talk about, they say that we're making this up, this illegal aliens receiving taxpayer benefits. It's a talking point, they said. I want to remind you of a couple of key facts. Everybody can remember, I think, back to 2020. In the presidential debate for all the candidates on the Democrat side, you might remember famously they were asked the question, raise your hand, they said on the stage, if you believe that illegal aliens should receive health care paid for by American taxpayers. Every single one of them raised their hand, to great applause in the audience from the Democrats who were there. Those hands included Joe Biden and Kamala Harris. Now, what did they do? Did they follow through on that promise? Yeah, they absolutely did. Joe Biden used executive orders, and he expanded benefits, health care, to illegal aliens in his 4-year term. That was an outrageous violation of the existing federal law and of the principles of good stewardship. Those resources are not meant for people who break the law and come into our country. They're meant for U.S. citizens. And so they watered down these health programs. It was terribly dangerous. So we got the majority. President Trump has returned to the Oval Office with a mandate of 75 million Americans as a big popular vote win. The House Republicans received our largest popular vote total in the history of this institution. Republicans went immediately to work. And we passed the one big beautiful bill, the Working Families Tax Cut. And we fulfilled all the promises that we made. One of the key promises that we made, because you all know that the open border was probably the #1 issue in the election cycle, was that we would end that madness. We would cut off resources, hard-earned taxpayer dollars by American citizens not going to reward people for breaking our law and coming over the border. And we did that. The one big, beautiful bill, the Working Families Tax Cut, included a huge provision. A big chunk of that bill was the health provisions. Now, why are we saying that they want to return and restore taxpayer-funded benefits to illegal aliens? Because that's exactly what they did. When they rejected the clean CR that we sent over, the Senate Democrats, Chuck Schumer, filed a counter-proposal. Now, what was in that counter-proposal? You can see it for yourselves. In fact, if you're watching at home, go to my website right now, speaker.gov. Go to the press releases tab, and you'll see it. It's listed right there. Just click on it. I'd like you to turn in your hymnals to page 57, okay? Section 2141. It is there in black letter. They filed this. This is not a talking point. This is what they proposed. They wanted to add, instead of the clean CR that keeps the government open for 7 more weeks to allow us to finish the work, they proposed a wild list of partisan priorities. Among them, they want to return $500 million to the Corporation for Public Broadcasting to prop up left-leaning and biased media organizations. We're not doing that. The American people don't want us to do that. We don't need the Corporation for Public Broadcasting funded by taxpayers anymore because we're in their age of ubiquitous media. There's, what, 200 of you guys here? There's so many outlets. We don't need to do that. We're not going to do that. They wanted to cut, in the Democrats' counter-proposal, I want you to read it for yourself, speaker.gov. Go there and check it out. They want to remove the rural hospital fund that Republicans fought so hard to put into the one big beautiful bill. We set $50 billion aside to take care of rural hospitals. Why would Chuck Schumer want to get rid of that? I don't know. A lot of those rural hospitals are in red states. You have to decide for yourself what the motivations are here. But they say they're for health care. Why would they want to do that? The other thing that they put in there is very important. And on page 57 in section 2141, not a Republican talking point, read from the Democrats' document themselves. They said that they want to repeal the health provisions of the one big beautiful bill. Why is that so important? Because I want to tell you what those health provisions did. They eliminated all of the taxpayer-funded benefits going to illegals. There was an amendment that was sent over to the Senate to ensure that illegals would not be getting health care paid for by taxpayer dollars. Illegal aliens, okay? 43 of the 47 Senate Democrats voted against that. This is just a few months ago. The bill was signed into law July 4th, and we cut all of that out. Let me tell you what some of those things are. The Democrats' counter-proposal CR, the dirty CR we call it, as opposed to the clean CR, would result in nearly $200 billion being spent on illegal aliens and other non-citizens. Let me be specific. This is just a few of the reforms that we put in that they want to repeal and reverse. Number one, a provision that closes the California loophole. Now, that's a provision that's also been adopted by states like New York and Michigan and Massachusetts. Other states have followed, other blue states. The California loophole allows taxpayer-funded Medicaid for illegal aliens. We eliminated that in the big, beautiful bill. Their counteroffer is to repeal and reverse that. That would cost $34 billion of U.S. taxpayer funds. Number two, a provision that prohibits Medicaid from paying more for emergency care provided to illegal aliens than it does for American patients who are disabled or elderly or children. We eliminated that in their counterproposal that they have filed that you can read yourself. They want to repeal that. That would cost taxpayers $28 billion. Here's another one. Number three, they've counterproposed a provision that ends the Obamacare funding for non-citizens. The cost of that repeal would be $91 billion to all of you. Taxpayers, hardworking American citizens, would be funding that. A provision that repeals the Obamacare special rule for immigrants. That cost would be $27 billion for taxpayers. A provision that ends Medicaid funding for those improperly granted asylum and parole under President Biden's open borders. The cost of that would be $6 billion. I think that's actually a low estimate. You know, President Biden intentionally opened the border and Kamala Harris for 4 straight years. By some estimates, 20 million illegal aliens came from every country all around the world, and a lot of dangerous people came into the country. And you know what they did? They granted them all asylum. They gave them all this parole status so that they could roll on to taxpayer benefits. We've all been funding that. Republicans said, no, that does not comport with common sense. We're going to do right by Americans and not everybody else. We're not going to incentivize illegal immigration. And that's exactly what Biden and Harris did. It's what President Trump ran on to end, and we did that. It took the president about 2 months, and he closed that border tight. We don't have that problem anymore, but we still got to deal with the tens of millions of people who are here illegally. We're working on that. So the Democrats' so-called reasonable counterproposal would reverse all those common sense reforms I just listed and more. And I don't want you to take our word for it. I don't want you to regard this as some talking point. I want you to go read it for yourselves. Speaker.gov, go to press releases. You'll see it's the first thing listed. Click on the bill and go through it yourself, and you'll see it. The result of all this would be $200
That is
billion.
House Speaker Mike Johnson holding a news conference following the government shutdown as it extends into another day, going on to say that Democrats aren't doing the right thing, calling them selfish and reprehensible. Let's get more on the government shutdown. I'm pleased to say that joining us now is Jim Millstein, Guggenheim Securities co-founder and former U.S. Treasury Chief Restructuring Officer. Jim, thank you so much for joining us as we head to another day of a government shutdown. And I think, if anything, that press conference shows that they are no closer to any sort of agreement. And we can go back and forth on when that agreement will happen. But what exactly is even at stake for getting this bill through?
Yeah, so, I mean, the rules in the Senate are, when you're passing a budget bill or a continuing resolution, you need 60 votes. So the Republicans have 52, and one hardline libertarian in Rand Paul who won't vote for these kinds of budgets, even on a continuing resolution. So they have 51 votes, plus the vice president can come in. They need 8 Democrats. They know they have needed 8 Democrats, which means that they, had to do something bipartisan to get a, quote, clean bill through. This bill, if it were passed, would only get you to November 10th or something like that. So it's a very short extension. And what has changed, I think, and the reason that there's been a lot of noise about Senator Schumer, he voted for the continuing resolution in March, but now he's leading a charge not to vote for this one. What's changed is they passed a bill that substantially reduces benefits. There are tax credit subsidies for people who participate on the Affordable Care Act's insurance exchanges that they've cut back in the One Big Beautiful Bill. And those cutbacks start on January 1st. So there will be just increased out-of-pocket costs for the 30 million people who get their health insurance through the exchanges. They also, in the One Big Beautiful Bill, made significant cutbacks to Medicaid, federal support for the Medicaid program. That covers 70 million Americans. And, I think the Democrats, these are programs that the Democrats, in the case of ACA, sponsored and pushed through the Congress. And in the case of Medicaid...
Now, Jim, it's not just Americans, right? I mean, Mike Johnson is claiming that the Democrats want those programs, the Medicaid and the ACA programs, to cover undocumented immigrants as well.
Yeah, I'm not going to weigh in on whether or not this is just a talking point to kind of position the public. And
well, for their base, that's incredibly important because they are extremely anti-undocumented immigrant, right?
Right. So look, every budget that is passed by the Congress reflects the spending priorities of that Congress. The One Big Beautiful Bill substantially increased Homeland Security's budget and substantially increased the Defense Department budget at a time we're running over almost $2 trillion deficit. So they had to find offsets to those spending increases, and they found them in healthcare, the government support of healthcare for poor people and middle-income people. And, that's not probably a winning political formula for the 2026 midterm elections. So there is bound to be compromise because these programs affect poor people and middle-income people across the country. This isn't a red state, blue state thing. So, for example, in Louisiana, in the Speaker's home state, 35 to 40% of the population is a beneficiary of either Medicaid or the insurance provided by the Affordable Care Act. So, maybe he's going to stand tall behind those cuts throughout the next year and a half, or maybe there's a compromise down the road. So I think what's going on in the Senate is the Democrats in the Senate are looking for a signal from Thune that the budget bill that will be passed, hopefully, for 2026, which has already started, will address some of these concerns.
It's split programming, though. Because at the same time that these issues are being debated, that Speaker Johnson is going on media saying that it's the Democrats' fault, you also have Caroline Leavitt, the White House press secretary, going on Fox literally at the same time saying that they're going to look at across-the-board layoffs, that the White House is using this as an excuse to fire people. Usually when these moments of tensions, when government shutdowns happen, people are just like, whatever, they'll figure it out. It won't have an impact. Is this time different, especially because of the fragility of the economy right now?
It's a little bit like Blazing Saddles. They've got a gun pointed at their own head. They're the chief executive officer of the country, right? They're going to need people to run the programs that reflect their priorities. So, the threat to fire people who would help them implement their agenda seems a little empty to me.
It does seem like just a threat, right? I mean, I know that President Trump has run time and again on shrinking the federal government, but it doesn't seem like this Republican Party really wants to shrink the federal government. Okay, they have 150,000 deferred resignations from the DOGE movement, but if they were really going to fire more federal workers, wouldn't they take advantage of this moment and do it? Rather than just threatening to do it time and time again. And we're going to do Democrat things, and it's going to be very bad, and not actually carrying through.
In the 1890s, there was a major civil service reform in the United States to prevent the kind of cronyism and patronage that previously prevailed. And so, they can threaten to do mass firings, but there are procedures that they have to go through that were enacted, 130 years ago and have been subsequently revised and amended. But, they can't just do this unilaterally. That's the problem the president is facing, is that he is eager to act unilaterally and show that, he's forcefully in charge. But it's a government of laws, not men.
Well, tell that to Clarence Thomas, right? I mean, he just recently said that he doesn't put a lot of faith in precedent. It could have been an orangutan making that decision.
That's
right. This Supreme Court seems eager to allow the president much more executive power.
No, there's no question about it. But notwithstanding that, the Congress has a role to pass budgets, to govern trade, right? I mean, so the president has, allegedly cut 8 or 9 deals with major countries on his universal tariffs. None of that's in writing. It's all press releases. He's allegedly got, a couple of $1 trillion of investment from these countries. Again, nothing's in writing, nothing's agreed. And why? Because the Court of International Trade, which has an original jurisdiction over the statute under which he's imposed these tariffs, has said he's exceeded his authority. That was appealed to the district court in D.C. They concurred in the International Trade Court's opinion. It's going to be heard at the Supreme Court on November 5th. This whole tariff regime that he's imposed could disappear with a Supreme Court decision. Now, as you've said, the Supreme Court seems eager to expand the powers of the president.
And we need that money.
But the powers of the president in this case derive from an act of Congress. And these kinds of tariffs have never been imposed under that act.
It's kind of this strange thing, because if you had said on April 2nd that these tariffs would be struck down by the courts, markets would have celebrated. This time around, anytime we've gotten an inkling, it is a bond market that sold off. It used to be inflation that concerned us about the tariffs. Now it's, we need this in order to cut the deficit.
Okay, so so go back to the one big beautiful bill. That we came into 2025 running a $1.7 trillion deficit. That's about 6% of GDP. So, when the government is deficit spending, it's goosing the economy. The one big beautiful bill, although, there's a lot of moving parts and pieces, increases that deficit for sure, with the exception of the offset of the tariffs. But since the tariffs have not been enacted by Congress, it's not incorporated into the CBO's forecast because it's unsure, the CBO, that these tariffs are actually enforceable. Bessent has claimed that at the current run rate, the tariffs will generate $300 billion of revenue in 2026. That will that might offset the incremental tax cuts that were incorporated into one big, beautiful bill, but it's not going to close the deficit in any meaningful way. So that's why I think the bond market should be a little nervous about what the government is doing, because as Chair Powell has said, and I've said here before, the debt is sustainable at the level we're at, but the deficits are not. We cannot keep doing this. Well, and, notwithstanding all the chest beating that the Freedom Caucus does from time to time about closing the deficits, they all voted for this bill, which expand the deficits. So, we have two parties in Washington. We have a cut taxes and spend party, that's the Republicans, and we have the occasionally raise taxes and spend party in the Democrats. The one thing that unites them is they know how to spend money. They have completely different priorities on how to spend it, which is why we're in a shutdown right now.
Jim, great to get some time with you. Wish we had more. Jim Millstein there of Guggenheim Securities. We are coming up to a break here, and we're looking at markets that have been wavering between gains and losses. Right now, you see red arrows on the S&P 500. The NASDAQ still up as the chipmakers continue to rise. U.S. 10-year yield notably at 4.1038. This is Bloomberg. A major milestone reached by Breeze Airways. The low-cost carrier has become the first U.S. airline in over a decade to be certified by the FAA as a U.S. flag carrier. That designation allows Breeze to make international flights, unlocking new growth for the four-year-old company. Joining us now is David Neeleman, a name that you surely know and are familiar with because he was the CEO and the founder of JetBlue. David, great to have you with us. Thanks so much for joining Open Interest. What is your plan for expansion of this airline now that you've gotten this incredibly rare allowance?
Well, we're up to over 50 airplanes. We're kind of growing we get an airplane about every 3 weeks. We have on firm order about 90 Airbus A220s with an option to go to 120. So it's just doing the same thing that we're doing. We're flying about 87% of our routes. We have no nonstop competition. So it's a perfect airplane size. We have first class, we have extra legroom seats. And this international expansion is going to be great for us because Saturdays are a little bit of a down day for air travel, but being able to take those airplanes and fly to Cancun and to Punta Cana and to Montego Bay, Jamaica is going to be a real great asset for us.
Well, David, for anyone who's not familiar with your resume, every airline you founded has done something to be disruptive, to reshape its home market. Morris with e-ticketing, JetBlue with more comfort for reasonable prices, Azul making secondary cities in Brazil, connecting them. For Breeze Airways, what is the disruption here that you're trying to bring into the market?
It's along the same lines of what we've done. I always say you never start an airline just for the heck of it. You have to start it with a reason. And when I looked at the U.S. market, 125 cities had lost more than 25% of their air service over the last 10 years. So the big airlines were forcing people to all their hubs, and cities like Charleston, South Carolina, Huntsville, Alabama, vibrant, growing cities, you basically had to get on a plane and fly to a hub. And so we're just taking people and bypassing hubs and going nonstop, but doing it with luxury. We're not really like a ULCC. We offer first class, we offer extra legroom seats, we offer really low fares. We have a kind of a basic economy equivalent, but then we have these bundles that people love to buy up. And we've got the highest NPS score I've ever seen of any airline I've ever run. We are voted by Travel + Leisure as the third best airline in the country, Apex #1 airline. So it's working. This combination of getting you there for, always when we started, I said, let's get you there twice as fast for half the price. That's kind of our goal, and do it with options to fly first class or extra legroom or have free Wi-Fi and a lot of things you don't see on a ULCC.
What are your biggest challenges right now, David? I mean, fuel prices have come down, but I guess planes are harder to get, more expensive, and labor must be the cost of labor must be rising as well.
Well, for a while it was the pilot situation, and that's totally been solved. We have 1,200 applications we open it up, and we have tons of applications. I think staffing at airports, we rely a lot on third-party people. So we're really focused on making sure that they're doing a good job and they're keeping us safe. We're coming with a program where we're going to put AI cameras on all of our gates to monitor everything that's going on, to make sure that the turn is efficient, but also, most importantly, safe, making sure that there's no damage to our aircraft. So that's really something we're really focused on is being efficient. And our on-time percentage has just gone through the roof. I think last month we were almost 90% on time. We didn't cancel a single flight all summer long because we just wanted to get our guests where they're going. So it's just really focused on the operation. I really preach if we flawless operation, then people will come back and fly us more often. And that's what we're seeing. These markets, if we go to a market and we see there's about 15 people a day that travel between two cities, we believe we can turn that to about 100 a day.
David, it does feel like an industry, though, that is split into the haves and have-nots. And in the have-nots, you have Spirit, which maybe has its own issue, but serving a lower-income market. Then the big airlines, United, Delta, talking about that they're doing well because of luxury. Ed Bastian yesterday at Atlanta Fed conference saying that you have the lower end of the consumer spectrum, it's tough. And then he goes on to say all of the other airlines are basically going to lose money or come close to losing money. Again, talking to airlines that aren't serving the ultra luxury customer. David, do you think he's right?
I think he's right to a certain degree, sure. There's you see now JetBlue's rushing to put first class seats in their airplanes. Spirit's trying to put first class, Frontier's adding first class. So yeah, I think people want choice. Southwest Airlines had one product for everybody, free bags, and now they're starting to differentiate. People want to say, great for the free bags, but I don't care about free bags. I just want a lower fare. So you have to give choice to our guests and along the spectrum, and make them feel good about every bundle that they purchase.
So I've always wondered about investing in airlines because, the prices haven't really risen much since I started buying tickets for myself 30 years ago, right? I remember going to a Grateful Dead concert on the West Coast in the 90s and paying about $300 for the tickets, and I could still do the same thing today. Why invest in an airline if it's never going to make money over time?
Well, trading some airline stocks is a little bit like trading like options. Basically, they're up and down a lot. I think there's a tremendous amount of leverage if you can get everything right. We have some of the highest margins in the industry on routes where we have no nonstop competition. So, I think our goal is to create something that is not akin to an airline, something that is, because the challenge that Spirit ran into is that their planes got so big they had to overlay Delta, United, American. And that's a really tough business to be in because they could just create basic economy and match everything they were doing. So it's just finding those markets. We've looked at those markets that have 15 PDUs, and we think there's enough market for about 400 airplanes, and we only have 50. So it's a tremendous growth opportunity, and there's a lot of leverage there if you can get it right.
Well, David, you've done it before. We're looking forward to following along your journey with Breeze. David Neeleman of Breeze Airways, thank you so much for joining us this morning. All right, we're over an hour into your trading day, a check on markets, and we have turned negative for the S&P 500. Sad, we'll miss out on that third record high. The NASDAQ may get its own record high. It is the chip stocks and NVIDIA which continues to carry the market. NASDAQ up 0.2% with your 10-year yield little change at 410, but it did fall below 410 yesterday for the first time, Matt, since the Fed decision.
Yeah, I have to say yields feel pretty easy. Really, financial conditions feel pretty darn easy right now.
So much cash out there looking for a home.
Take a look at Tesla. Right now, it's down 1.33%. By the way, I mistakenly said earlier it hit a record high in the shares. It hasn't yet, and it has to get back to the levels that we saw in December of last year. But it is now worth more than $1.5 trillion, and it did hit a record in terms of its vehicle sales. Stellantis also posted its first quarterly sales gain in over 2 years, and those shares continue to rock higher. Right now, the gain almost 7%.
That's a chunky gain this morning. Elsewhere, Berkshire Hathaway, they've made their biggest acquisition in 3 years. Remember all that cash that Berkshire has been sitting on? Finally putting it to work. They've reached an agreement to buy Occidental Petroleum's chemical unit. That is a $9.7 billion in an all-cash deal. Again, it's a Berkshire Hathaway that for so long had said, we're comfortable sitting in cash. There's not a lot of deals out there. Perhaps a sign at the times that we are getting activity from them.
We have FICO story today. The Fair Isaac Corporation announced a new program that gives mortgage lenders the option to calculate and distribute FICO scores directly to customers. Nathan Dean says that basically lowers the price of getting a credit score for a mortgage issuer to less than $5 from $10. That hurts the competition. TransUnion, Equifax down substantially, but I think it's amazing to see the eye-popping gain at FICO right now, up 22% to a $45 billion market cap.
Yeah, at the start of trading, it was halted because it was so volatile, but it completely disrupts the business model for TransUnion, for Equifax, hence the losses that we're seeing. Sadly, in talking to Nathan Dean, it doesn't sound like it'll make any difference for us who have to be beholden to FICO.
Absolutely.
Scores.
It's amazing.
That's the tragedy
That's a $45 billion business. All right. After years of getting shunned by major banks, President Trump's money has found a new home at Citi. Details on that scoop. Next, we bring in Todd Gillespie from our finance team. This is Bloomberg Open Interest.
For years, President Trump's money was getting shunned by all the major banks in the U.S. Now his wealth has found a new home. Citi. Bloomberg sources reveal that President Trump's son, Eric, established a trust at the bank that holds some of the president's money. For more, we're joined now by Bloomberg banking reporter Todd Gillespie. Todd, first of all, fantastic story, but what exactly is the arrangement that Eric has found with Citibank?
Yeah, thanks, Dani. I mean, so what we do know is that since the election, Jane Fraser, as many corporate leaders in America did, reached out to President Donald Trump to congratulate him. As part of those talks, in some way, Eric Trump ended up becoming a client of Citigroup. We know that he's now a client of Citigroup's private bank and has set up this trust where he is basically managing, or sort of the trustee of this trust, essentially. But the money in the trust is his father's, and it's for the benefit of his father. His father is a beneficiary of this trust. So we know now, the president's finances have obviously been a matter of, intense interest. Generally, the family and the president have already had to disclose one trust that we know was set up several years ago, the Donald J. Trump Revocable Trust, which is at another bank and largely looked after by Don Jr., as we understand it, as legal filings show. This is a new trust, a previously unreported trust, which again, helps us put another piece of this puzzle with the president's wealth.
And I mean, during the first administration, there was a question about how inflated the president's wealth was from his perspective, whether he really was worth more than $1 billion. And now, I mean, since the November election, his wealth has skyrocketed. We now have him pegged at about $7.7 billion on the Bloomberg Rich List.
Yeah, that's right, Matt. Yeah, his wealth has more than doubled, essentially, since starting his second presidential campaign. So, aside from the fact he's the president of the United States, he's also a very valuable client, potentially, for any bank like Citigroup. But also in the context right now, no suggestion necessarily of a quid pro quo or anything like that, but every bank across Wall Street is doing their best to ingratiate themselves with the administration, but particularly for Citigroup right now, they need support from the government. They need to be in the government's good books because they have two key regulatory consent orders that are hanging over them and have been since 2020, and they got a big fine from the government regulators last year. So Jane Fraser, it certainly doesn't hurt that she's in the good books if indeed this is part of that, in the Trump administration. And she was one of two U.S. bank CEOs that attended the state banquet in the UK just last month with King Charles and President Donald Trump, That
And Brian Moynihan.
And Brian Moynihan, yeah. It was Fraser and Brian Moynihan of Bank of America. And Fraser herself was sat next to one of the White House deputy chiefs of staff.
Who is married to what?
Who was married to the former assistant of Jared Kushner, whose family also banked with Citigroup, and that is a long-standing
It was honestly a great
relationship.
story, Todd. I read every single word.
It was a really good story, and it's just kind of the strange, because we remember Davos, where President Trump lashed out at Brian Moynihan, who was kind of left speechless and didn't know really what to say to him. It seems like a turn in favor if all of a sudden they're having dinner at the White House with President Trump.
Sure. Well, and we do know that JP Morgan as well, Jamie Dimon, has been on the receiving end of Trump's ire as well. But one bank that has largely escaped criticism here, never really been, a target of President Trump's public comments, is Citigroup. But we do know that Citigroup had a banking relationship with the Trump organization or Trump's businesses back in the 1990s and did lose money on that. They were burnt, when Trump had his experiment with Trump Shuttle, the airline that faltered, big real estate loans that needed to be restructured. Citibank kept cropping up there as one of the largest lenders. Obviously, that relationship soured, went quiet for many years, and now it seems like they're back in some form.
I think it's interesting to watch the two brothers kind of jockey for position, right? During the first administration, it was Trump's daughter who was seemingly the favored child, or certainly more in the public spotlight, right? And now you have Eric Trump kind of rising up, his profile getting almost bigger than Donald Trump Jr.
Especially with all the crypto stuff that he's
exactly.
doing.
Yeah.
And they've made so much money with that.
Oh, yeah. Yeah, I mean, Eric Trump, we know, is the executive vice president of the Trump organization now. He has been a key part in building a lot of these relationships on behalf of his father. Donald Trump Jr., Don Jr. is, doing private equity, venture capital stuff on the side as well. But, this is the second term right now. These relationships have been built across New York, across the world, across the Middle East now, of course, as well. And these sons are certainly playing a key role in cultivating that.
Todd, great story. Highly recommend that our viewers check it out. Todd Gillespie, a reporter on the finance team, covers Citi for us. You can find his story on the Bloomberg Terminal or on Bloomberg.com. Coming up, the government shutdown is set to delay tomorrow's payrolls report. We'll discuss what else to watch out for next. This is Bloomberg Open Interest.
Don't ask the Republicans what we should be doing or what we should be negotiating. I don't have anything to negotiate. I sent them in good faith exactly what they had voted for before. We did not put any Republican provisions in that. And we tried to make this very simple, in good faith, so the appropriations process of the people can continue.
And that was House Speaker Mike Johnson speaking earlier. Bloomberg Washington correspondent Tyler Kendall joins us now. So, Tyler, what did we learn from Mike Johnson? He took us through, I think, the minutia of some of the big, beautiful bill and what the Democrats, for example, want to repeal.
Right, exactly, Matt. At this point, we haven't really gotten any indications that we're any closer to bridging this impasse that lawmakers are currently at. I will highlight some of the headlines that House Speaker Mike Johnson made when it came to potential layoffs, saying that the OMB does have the power to decide the essential workers and who may or may not keep their job at the end of this shutdown. It's certainly setting up a potential legal fight here around the breach of executive authority, something that we've really seen this White House expand, though we're going to have to see how it ultimately shakes out. President Trump, of course, set to meet with the OMB director, Russ Vought, later today. But we've already seen the OMB take some actions already, such as withholding funding from some clean energy projects that happen to be in states that did not vote for President Trump during the election. So we're watching really closely here how these priorities are ultimately going to align.
Tyler, thank you very much for that update. Bloomberg's Tyler Kendall in D.C., who will keep us up to date if there are any changes. But for now, the government shutdown, it's been delaying the release of key economic data. We've gotten private surveys of the data. We have the latest Challenger report, which showed employees dialing back hiring plans in September, but also not really firing people either. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. Mike, it was supposed to be a big jobs week, and we're not necessarily getting that. We are getting the private data. So how are we looking at the tea leaves if we don't have the official government data?
We're calling it the Seinfeld data releases. It's a show about nothing, as they say, because the jobs report is what is most important to the Fed, and it just leads off what a long list of things we're not going to get this week. We're not getting jobless claims today. We didn't get those factory orders, payrolls tomorrow. We don't get the trade balance next week, jobless claims next week, probably not unless they get this settled. Wholesale inventories, which matter to your GDP calculations. There are a few things that do happen. We get the ISM services number tomorrow, New York Fed inflation expectations, and Michigan sentiment next week. I'm assuming that Mike Johnson's attitude means we're not going to get this settled anytime soon. So that just leaves the Fed as the thing you're going to be looking at. And as you can see, we have a whole lot of Fed speak, including the Fed minutes next Wednesday. So maybe they'll have something intelligent to say about what they don't know.
I have to say, to your Seinfeld point, one of our producers, Joe Chiaffi, he wanted to show the ECAN screen every time we're supposed to get a data release, hoping that Michael McDonough's team would just put a blank, bar in there.
Or maybe there's like a rogue employee at the BOS that just decides to put it out there, even though they're furloughed.
A couple data points. We do have a wall of alternatives you can look at on the Bloomberg. If you type WSL space ALTE,
correct,
you're going to get things like ADP. You might get something like the Challenger report that we got out this morning. Are there any of these alternatives, Mike, that are worth putting your faith in? Compared to, Austin Goolsbee said the non-farm payrolls number is the greatest piece of labor data in the world.
Well, you put it that way. Putting your faith in, no. They're all incomplete data points, and they all have their flaws. And so you're stuck with what we have. It's not going to be the gold standard. But you go through that WSL ALTE page, which we are promoting relentlessly here. And you'll see there are a lot of different things you can look at. You can look at the Challenger report that came out today with the slowest hiring plans for the year so far since 2009 and the weakest in a month since 2021. And you can say, okay, we probably would see a slowdown. ADP gives you the same answer even if you don't believe the negative 32,000 jobs. So there are indicators that will give you some sort of hint as to where we are, but the exact numbers, and in particular the unemployment numbers, the unemployment rate, which is what the Fed is really concerned with, you're going to have to guess on that. The Chicago Fed puts out a number it thinks is going to be very equivalent to what the September number is for unemployment, and they've got it going up just a little bit, but it too is lacking all of the data inputs that would give you something you can put your faith in, as you put it, Matt.
All right, Mike, great having you on the program. Michael McKee there, our international policy and economics correspondent. We're just heading to the top of the hour here, and we're looking at a loss on the S&P 500. Now, when we kicked off the show, Dani, it looked like we were going to get a 30th record. Was that right? 30th record high for the S&P this year. It still could happen.
Sure.
We still have 5 hours to go until Romaine comes on at the close.
And already the NASDAQ looking at hitting a 29th, but it's the split screen of NASDAQ, big tech doing well, $500 billion valuation for OpenAI, and the White House saying that they're going to be firing thousands of people with this government
Rick
shutdown.
Reeder is still going to join us tomorrow. Definitely a show you don't want to miss.